Asset price booms have triggered many episodes of financial instability, and there's an ongoing debate about the role monetary policy should play in containing such bubbles. Chief Investment Officer from Piguet Galland Cie, Daniel Varela, joins me now to discuss present monetary policies and their effect on asset prices. Daniel, thank you very much for coming into the studio. Now, we'll start with a basic question, but one which genuinely triggers quite a lot of different responses. How should and how do asset prices affect monetary policy?
Good morning, Rowena. In fact, we have different schools. Mainly, we have two different schools. We have the European one and the Federal Reserve one. The European monetary policy, in fact, we have European central bankers that do have a mandate to fight inflation. So basically, they are very frightened by asset price inflation because they tend to think that it leads in the end to consumer price inflation. So they will do whatever they can to fight asset price inflation because they want to be preventive. At the opposite, you have the Federal Reserve that has a double mandate, not only fight inflation, but also promote economic growth. So they will tend to be less concerned by asset price inflation probably because of the depression of the 30s, they tend to think that they know how to control inflation, consumer price inflation, but they tend to think that it's more difficult to get out of a depression and of a situation of deflation.
Okay, so in that case, can monetary policy be used to stabilise asset prices?
Absolutely, because asset prices normally are the first prices to react to monetary policy. We can see that in the markets. When interest rates go down, normally you have asset prices going up before that economic reacts, because the asset prices tend to anticipate what we will have as an economic situation down the road. So it is possible by having a more accommodative monetary policy, it is possible to control to stabilize first asset prices and then to make them go up. Obviously, if they go up too much, then you have to control this asset price inflation. And then by resorting to a more tightening monetary policy, then you are able to control asset prices if they are going up too much. What we have today is a situation where in recent years we had very low interest rates and very accommodative central banks, at least in developed markets. And you had a lot of quantitative easing going on. So there are some possibilities that we could experience at some point, some asset price inflation or even asset price bubble.
Okay.
Probably it won't come in developed markets because we have still a lot of cleaning to do. But we can think about emerging markets or even commodities as traditional candidates to experience some kind of asset price bubble.
Okay, well, speaking about overly low interest rates, there's evidence to suggest that overly low interest rates actually encourages banks to take too much risk and therefore, of course, can threaten financial stability in itself.
What we've seen over the last 30 or 40 years is that central banks have been better in terms of using their monetary policy to control the economy. And they were able, in fact, to smooth economic cycles. So this led to economic agents, not only banks, but also households, companies, to make them feel more comfortable regarding to the economic cycle, because the economic cycle became more predictable. So as these different economic agents became more comfortable, they became more comfortable taking more risk and taking more debt. And this led to this financial instability that we have been experiencing recently. But this financial instability led to people becoming more averse to taking too much debt. So they are taking down the leverage. We see that with banks taking leverage down. Also households in the States, for example, taking their leverage down. And this will lead to, well, a new situation where debt will be down and probably people will become more willing to take more risks at some point. So history repeats itself.
Of course. Now, if we use the US as an example, despite both accommodative monetary policy and fiscal stimulus, there's still a gradual pace of improvement for growth, etc. Now, it seems like there's no real near-term end to this liquidity trap, is there?
It's true that after the crisis of 2008, banks became, well, less willing to lend money because they had bad balance sheets. They had to clean their balance sheets. So they took all the money that the Federal Reserve provided to make some kind of carry trade. So the short rates were so low, they were really happy to take this money, at least, well, almost for free, to invest that on treasuries. So this made them able to use banks, in fact, to improve their balance sheets and improve their earnings. Now, we start, in fact, to see that US banks are lending again. They are not lending for real estate loans, but they start again lending for consumer loans or commercial loans. So we see that after 4 years of balance sheet cleaning, they are at the end of this process, and probably they are becoming more comfortable with the economy and the state of their balance sheets, and they are lending again. So we see signs that credit growth is improving in the States, and that probably says that the US liquidity trap is over. But it's not over in Europe, in fact, because it's at least beginning.
Yes, exactly.
We think it's beginning, and probably it will take some time. Also, European banks will need some time to clean their balance sheets, and probably we will have some kind of credit decrease, and probably it will take a few years to see credit growth in Europe also, and probably we are in the middle of a liquidity trap in Europe.
Daniel, thank you again for coming into the studio. So there we have it, Daniel Varela from Piguet Galland Cie on asset prices and present monetary policies. Now next week we'll have more Hollenbeck Unleashed, Arab Bank and plenty more guests in the studio, but for now, goodbye.